All right, welcome everyone. Good morning. Just give us a minute to go live on all the platforms and we will get started with today's show. Got the chat up. If you're tuning in, you can check in. Good morning, Roz. Good morning, Christina. Just give us a few more minutes, get live on all the platforms, and we'll get into today's show. Good morning to the team and everybody tuning in. Looks like we got some more platforms. Just give us another 30 seconds or so, and we'll get into today's show. Thank you all for tuning in early. All right, excellent. Let's get started here. Thanks everybody for tuning in. If you have any questions about our program that we're going through today, you can drop them in the chat again, and we'll get to them at the end. But let me go ahead and take that off for now. Welcome everyone. My name is Nick Hiersche. I am the president and founder of the Mortgage Calculator. We are a non-delegated lender that specializes in alternative income documentation, aka non-QM loan programs, as well as conventional FHA, VA, USDA, all the standard stuff. So I'd like to thank everybody for joining us today. It is March 9th, just after 11 a.m. Eastern. So we have live rates on all of our standard programs. So we can go through those today with some basic scenarios. Once we finish the live rates for today, we're going to introduce Jose Gonzalez, our sales manager, to go into a deep dive on a specific program. We mentioned it yesterday for self-employed borrowers, but we're going to go into the specifics of the 1099 programs. Definitely kind of a twist on the self-employed stuff. So Jose will talk about that for a little bit. So since we are live today and the rates are up, let me pull up our pricing tool and we will get started. Let me switch my screen real quick. And share our pricing tool. All right, so this is our pricing tool for our loan officers, our mortgage professionals. If you'd like a full loan estimate, please get with our team. We have over 300 licensed loan officers in 22 states for primary and secondary homes. And for our business purpose DSCR loans, we can do those in almost all states. So please get with us if you want the full quote. We're going to use this pricing tool to get an indication of rates just for today for our standard programs. Which is, it's March 9th, again, 2023, just after 11 a.m. So we're going to check out the basic rates on our standard scenarios. So what we will set up today for all of our examples, we'll use a nice, easy 400,000 loan amount. We will use an LTV of 80% loan to value. That means 20% down payment for our examples here that we're going to do. We're going to use our desired price. We're going to tell the computer to look for the best rate at one discount point in cost. Most of our borrowers are asking to buy down the rate a little bit. So we'll go through our examples with that set as the request. And we're going to go through an example for our conforming conventional first. Then we'll go into FHA, which is a great option for most of our borrowers. And then most other lenders and banks do not have any other options, but we have over 4,500 loan programs under expanded guidelines, aka non-QM, which we'll go over in detail. Now, VA is also an option if you do qualify. If you're an eligible veteran, we thank you, and we can quote that quickly. But since not everybody is an eligible veteran, we don't do that live today. And same thing with USDA, we can quote that very easily, but not everybody is looking in a rural USDA eligible area. If you are, please get with our team, and we'll be happy to quote it. Let's go into our first example. We'll do conventional rates here. We're going to set everything today to a purchase, 30-year fixed, standard loan, primary occupancy for our first set of scenarios. Single family, 1 unit, keep it nice and simple. State of Florida, Miami-Dade, that's where our office is based, so we'll keep it for there. We'll use an estimated FICO score of 760 for all our examples, and an estimated debt-to-income ratio of 40% for all our examples. So let's go ahead and check out our live rates for today. A little bit of positive action. So yesterday we were at the 6.99 for one discount point. It looks like we have one program that went down a little bit, so that's great. 6.99% rate for 0.875 in discount points. So great option here for our borrowers that qualify for conventional loans. And you can see we have a bunch of different options here, but these are pretty standard across the board. Now, if a borrower for some reason doesn't qualify for conventional, we typically go to FHA. So the next example we always want to do is an FHA loan example using the same scenario. So 80 LTV, everything else staying the same, so we can compare our conventional rates to our FHA rates. As I say every morning, FHA did make an announcement. The government made an announcement that the annual mortgage insurance, remember, FHA has an upfront mortgage insurance and an annual paid monthly, and they have reduced those. So now we see some great options for FHA. Obviously, the rate is lower here, as you can see. We have an option for 6.125 rate for 0.625 in discount points cost. So that looks like the best combo there. A great option. And remember to compare APRs. So the APR in that example is 6.714. So we can compare that apples to apples to the conventional loan. And as you saw on the conventional, the actual APR for conventional is just over 7 right now. So FHA, very valuable option for our borrowers. So please get with our team. We'd be happy to quote both side by side so you can compare. Definitely picking up a lot of steam on the FHA loan programs. Now, if a borrower for some reason does not qualify for conventional or FHA, which does, FHA gives us some expanded debt to income and credit guidelines. But if for any reason a borrower doesn't qualify or maybe can't qualify for enough home, many other lenders or banks do not have other options. Thankfully, here at the Mortgage Calculator, we have over 4,500 non-QM loan programs under expanded guidelines. So what that means is we have programs with expanded guidelines beyond the conforming conventional and FHA, and we're able to use alternative income for these programs. So we'll keep everything else the same on our scenario, but you'll notice we have a new option now with our non-QM. We have our different income verification options. So full doc is 2 years tax returns, same thing we have to do for conventional or FHA. So typically, when we're going to non-QM, we're going to look for one of the other options besides full doc, which would be 1 year alt doc, 2 year alt doc, asset related using an asset account. We've done a few shows on that. Check those episodes out for a detailed dive from Jose on those. We also do business bank statements. 12 and 24 months are very popular. Investor DSCR, that's our most popular program by far for investment properties. We'll do that in a second. And for non-QM primary residence, which is what we're doing right now, our most popular program is our personal bank statements using 12 months of bank statements. And this is going to be for our self-employed borrowers. So typically a self-employed borrower, when they do 2-year tax returns, oftentimes maybe have some write-offs and other things that don't quite allow them to qualify either at all or for the exact amount of loan they're looking for. So we can go ahead and use 12 months of their bank statements to then determine a debt to income ratio. So in this example, we're going to use 12 months of bank statements to determine their actual cash in the bank debt to income ratio and typically qualify a customer when they don't qualify or qualify them for more loan amount if they were looking to purchase a home worth more or with a larger loan amount. So these are great options for our self-employed borrowers. Now let's compare these options. So you see here, the first one that pops up is a 7.625 rate for 0.75 in discount point costs for an APR just over 7.5 at 7.664. So notice when we compare apples to apples, the APR is going to be a little bit higher for non-QM, a little bit higher than conventional, remember? And then FHA was actually even lower than both of these. So at this point, FHA would obviously be the lowest cost, but in this case with the non-QM, we can qualify our borrowers for more. So many times, borrowers will need this option, and we love to provide these alternative options for borrowers who need it. So it is a little bit higher APR, a little bit higher rate, obviously, but very much so in the realm of the conventional right now. So I definitely recommend for all of our team out there and all of our borrowers out there that are watching, make sure you check out these non-QM options. They're very comparable right now. Many times we do this show and the rates are a little bit further spread apart. Right now, they're very comparable. So definitely check out these options for your scenarios. Now, before we switch it over to Jose for a deep dive into another non-QM program that we could pick here, but we'll let Jose do that. We always want to do our investment properties. So we'll do our last two examples here for investment property purchases. We love to work with investors at the Mortgage Calculator, whether they're a first-time investor or they have 100 properties. We love to give them options, right? So we're going to compare a basic scenario. Again, the same exact scenario, 80 LTV, 20% down payment for an investment property. And we'll quickly do our conforming conventional example and compare it to our expanded guideline non-QM examples. Remember, FHA, VA, USDA, they are not eligible for investment properties. So very simple to compare these two options. So we'll start with our conforming conventional. Everything else is going to stay the same as we've had it before. And let's check out our conventional rates for investment properties. So you'll notice here the computer's not able to find a rate for one discount point in cost. So unfortunately, the GSEs, the Fannie Mae and Freddie Mac have added loan level price adjustments for investment properties. So even if we want to go up in rate, you see the computer found looks like a decent combination here. I would probably pick this one, 7.49 rate for 3.125 in discount point cost. Most of our investors would ask for other options, right? To go a little bit higher in rate, maybe to lower the discount point cost. Most of our investors that are buying investment properties want to save money out of pocket to invest in other rental properties, right? So unfortunately, with conventional, we don't have many options for low discount points. It's still great rate options, but that's where we love to present our non-QM options. So for our investors that want lower discount points and don't mind going in a higher rate, we have those options. So for our last example today for the live rates, let's go back to our pricer, pull up the same exact scenario, investment property. And this time we're going to do expanded guidelines, aka non-QM. And we'll get to select our two options. First is the income verification option for investment properties. The most popular program by far is our investor DSCR program, because again, that does not require any actual employment or income from our borrower. We're simply going to use the estimated rental income from the property to determine if that estimated rental income from the property can cover the housing expense of that loan, right? The PITIA for that specific property. So very good options we have once the gross rents cover that. So that's a ratio of 1 and greater. So tons of loan options that we have for that under DSCR. But we even have options for lower than 1 properties that don't quite cash flow, down to 0.75, and even no ratio options down to 0. So a lot of different options under this program. But let's check out what we have today. The next thing we always have to select is our prepayment penalty. That's typically standard for our investment properties under non-QM. We can obviously choose 0 prepayment if we choose. That will limit our loan options and obviously cost more. So typically we're going to always do the show today with our standard 3-year prepayment penalty. That's pretty standard for these programs. And there's even a 5-year option if you want to save a little bit more money, but not always has the most loan programs. The most common is 3 years. So that's what we'll use today to show the most common options. And now let's go into our last example and check out our DSCR rates this morning. So it looks like our best combo this morning is at 8.99 rate. So obviously a little higher rate here, but notice lower discount points. So our investors that are trying to save money out of pocket can now go with a 0.975 option for discount points, where you saw conventional was in the 3 discount points and more cost to our investors. So even though it is a higher rate, most of our investors are okay with that as long as the property cash flows and they can save some money out of pocket. So we love to compare these options. If you're a borrower or you are the borrower and you qualify for both, no problem. We'll compare them both, give you both options side by side so you can decide which option works better for you. These DSCR loans are great because we can obviously do multiples because it doesn't require any income from the borrower. So we can, cash out multiple rental properties to buy more rental properties and really get flexible with these programs. You'll also see we have a ton of options with varying DSCR values and varying prepayment penalty figures. So please get with our team. It's pretty complicated, but we'd be happy to show you the exact which ones of these exact dozens of programs we have that fits best for your scenario. Some of these that you see with the higher rate maybe allow short-term rental income or some other variations, maybe a credit event such as a foreclosure, other things that force us into these other special programs. So just tons of options that we have. Please get with our team and we'd be happy to navigate you through all of these scenarios. So that's it for today's live rates. Now I'm going to pass it over to Jose to go into our detailed deep dive example today. So let me switch up my screen and introduce the topic, and then I'll have Jose take over. Give me 1 second here. Switch this back. And so today our topic is going to be on a very specific subset of our non-QM loan program. So we just did an example for bank statements, which is probably the most common request that we have. However, there are times when a bank statement loan doesn't work. So Jose mentioned it yesterday on the show where he presented all the different self-employed options. However, 1099 is a very specific solution to a specific problem. So we want to make sure we go into a deep dive today on this specific solution. There are many people out there that qualify for these types of programs because 1099 is obviously something that's more common these days with more of the gig economy, right? With like Uber and things like that. A lot of people will have one or more 1099s from different sources for their activity, and we can then use that for the loan. But I'll let Jose go ahead and explain this. So Jose's our sales manager with 27 years of experience, both as a realtor and a mortgage loan officer, obviously, and so has put a lot of these deals together and can really give us some insight on when we need this specific program and this tool that solves a specific problem. Sorry. Go ahead and take it over, Jose.
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates with the Mortgage Calculator. Jose Gonzalez here, sales manager, licensed as both MLO and realtor since September 1995. 1099 is very interesting and misunderstood document because there's many MLOs out there that take 1099 applications and put the borrower as an employee because many times the borrowers think that that's what they are. Yeah, that's where I work. That's where I go every day. But unfortunately, for different reasons, the employer decides to put the tax liability on the borrower, makes him an independent contractor, and therefore they are self-employed. They're usually then going to have to do a 1099, and then they're going to have write-offs, right? Usually they end up having a lot of write-offs, which is what becomes a little difficult when we're looking at a 1099 borrower who's self-employed as full doc, because then we have to look at tax returns. We got to do a 1084 or Form 91, depending if we're going Fannie Mae or Freddie Mac income calculator, and that's where we run into problems, right? Because they take a lot of expenses. They don't want to pay taxes on top of their own income tax, and they got to pay the other side of the income and payroll taxes and all that as well. So there is a solution to this, though, right? We love having solutions for everything. And the solution is that the 1099 borrower is self-employed, and we have programs which will use that 1099 document and we'll just adjust it for a certain percentage. Some say 80%, some say 90%. A lot of times it may depend on the nature of the business that they do and how much overhead that type of job may or may not have. But the good thing is that with this method of doing it, usually the expense factor that's taken into consideration ends up being a lot lower than the actual expenses that the borrower is taking. So it's a win-win situation. The borrower gets to continue with his current income tax liability strategy, and we get to provide a solution to the borrower for their being able to purchase the home that they really want. So we have 1099 options for primary purchases as well as investment purchases. So in the first example I have for you here, it is a primary purchase with only 15% down. Actually, no, wait. primary purchase with 10% down. Let's go with that one first, right? Of course. So here, mind you, this is primary, 10% down, no mortgage insurance. Remember, non-QM never has mortgage insurance. So when you see these rates at a higher than 80% LTV, keep that in mind, no mortgage insurance. So in this case, our lowest cost option is 9.99%, and this is for a $675,000 mortgage and a $750,000 purchase. And our lowest rate option with a cost of approximately 2.5 points is 8.875. So 1099 option, minimal documentation, great rates. So now we go to our 15% down option. You'll notice there's over a 1% drop in the rate. Here, your lowest cost option, 8.875 at par, with the lowest rate option, 7.75 at roughly 2.5 points. So very good options. Again, no mortgage insurance, 10 and 15% down options. So now we go to an investment. Very good rates on the investment, but it is 20% down here for the 1099 option to be able to get rates that are in compliance. So we have 8.375% as the lowest cost rates, and that's at par, and 7.375 as the lowest rate options. And by the way, these are for a 1-year option, 1-year 1099, which would be obviously the simplest, just like we like to do the 12-month bank statement instead of 24 months. It's the same concept. We don't want to extend the review period to 2 years, because then they're going to be looking at things like averages, possible declining trends. So we'd like to keep it simple. So this is 1-year optional. So investment purchase, 20% down. You see very good rates. I'm going to compare that to the primary purchase, 15% down. Still has the investment purchase, still has better rates, and obviously 20% down. So now we're going to do some cash outs. So primary cash out at an 80% loan to value. You're looking at 9.125. Lowest cost option actually has a little bit of a lender credit, right? You got almost a 1/4 point lender credit there, with the lowest rate option, 7.875 at just under 2.5 points there. So that's our primary 1099 cash out. And we have an investment, and that's at 80% LTV. And then we have an investment cash out as well at a max 80% LTV. So you see 10.25%, 10.25 is the lowest cost option, and you can buy it down to 9.25% at a cost just under 2.75 points. So very good options here to go as high as 90% LTV on a primary purchase and 80% LTV on a cash out refi, again using 1099s. And some of these programs allow you to use as much as 90% of their income, right? So very, very good option here.
All right, thank you, sir. Let me pull up the three-way screen. So we had a couple questions in here, Jose. First off, a great question from Ben. Are these 1-year or 2-year examples? You mentioned it on one quote, but for the other quotes, what were they?
They're all 1-year examples.
All of them. Okay.
Yes, sir.
For primary and investment, both.
Yep.
Okay.
So
that's a great example. That's again why we love the flexibility of non-QM, right, Jose? Is even if we were able to qualify the customer conventional, you're always stuck with basically 2 doc, most of the times conventional as well. So we can just choose 1 year if we know that's what we need with all of our non-QM stuff. So we love those options. Someone had a comment that the rates are great. Well, thank you for tuning in there. We appreciate that. Let's see, anybody else? Uh, here's a question. Had a realtor client who depreciated their 5 investment properties to the point of having negative income on the tax return. Would the 1099 work for such a client? So we're not using
Well,
tax returns, so kind of a catch-22 there, though, right, Jose? But
yes, but you got to look a little deeper into the scenario. That's actually not a problem. Depreciation is a recapturable loss expense, right? So all of that depreciation that they took on their Schedule E in the tax return could be added back to the income. So depreciation, mileage can also be added back depending on the year. It could be 26 cents a mile, 27 cents a mile. They adjust it per year. So those two expenses we can add back, as well as business use of the home is another one that can be added back if they have it. So that one is not an issue. But if we talk about other expenses that they may be taking that you can't recapture, like repairs and stuff like that, then yes, the 1099 program is great for realtors, if you know, because realtors typically they get paid with a 1099, whether it's to a personal name or whether it's to S corp or an LLC. It's always going to be a 1099.
yeah, realtors are a great example. We love to work with realtor clients, right? And there's always some choices, right, Jose? We're always going to go bank statement, P&L, or 1099. Those are really the three choices for a great example of a realtor who's always paid via 1099, but we can use any of those channels. So can you go over, Jose, just real quick, because we talked about it yesterday, but why would we choose bank statement? Why would we choose P&L? Why would we choose 1099? Because those are the kind of the three flavors for a great example of a realtor in this situation.
What you're saying, why would we choose it as
one
opposed
one or the
to?
other or whatever. What are the
Okay,
nicknames
well,
for you?
if we've already decided that we can't go traditional full doc with the tax returns and we're analyzing our self-employed borrower, well, we have to see what we're dealing with. I mean, if the borrower has 1099s, right, then 1099 would probably be one of the better options, right? But you really, have to at that point look at the rates and see which is available for each. Now, because if your borrower is so lucky to have 1099s and good bank statements, and they're self-employed, good bank statements with the flow that you need, then you analyze the situation to see which is worse. Because normally with the self-employed borrowers that we have, they usually do not have a 1099, and they usually have either bank statements or a profit and loss report. So definitely, I would say 1099 is simpler to structure than a bank statement loan. Less hoops to jump through. Then the bank statement would be next in the pecking order, and then after that, the P&L would probably be the one that would require a little bit more documentation as far as tax preparer or accountant or CPA prepared profit and loss. But I do remind everyone, the profit and loss does not have to be audited. It is an unaudited compilation of income and expenses. But
So a realtor is a great example because they actually do have a 1099 and
yeah,
bank statements,
yeah,
and we can prepare a P&L. So that's a great example of someone that does, or like an Uber driver, right? Uber, Lyft, whatever, food, Grubhub or whatever, right? They got three 1099s, same thing, right? Someone that with 1099s fortunately has that luxury of three options, right? So that's pretty cool. Some people don't have a 1099, and they'll be bank statement or P&L will be the two basic options for us. So
what I have found, I believe, is that the bank statement option offers more choices. There's more choices of bank statement options, and I think that because there are more choices out there, there's a little bit more competition for the business. I think the bank statements probably offer a little bit better rate.
but they're a little harder to qualify, right? So the
Yeah.
1099 is a little easier, as Jose mentioned.
Yes.
Here's a good question. A Smith, can it be a combination of bank statements and 1099?
I don't believe so. Then that's like a very guideline specific question where we would really have to dig into the guidelines and see if they accept multiple income streams. Typically, most of them will allow you to do bank statement and like W 2 income if you're have your self-employed business, but you're also a W 2 employee somewhere. They would allow you to do that, or to have a borrower that's bank statement and a co-borrower that's W-2, for example. You can have that.
Mhm. Yeah, but 1099 and bank statement would overlap, right? The 1099 income should show on the bank statement, so you usually wouldn't have both of those. So you can do some, but not. I don't think the specific combo is possible. Another great question here from Ben. Is the CPA the only way to get the expense factor? So remember, whenever we have some of these non-QM programs, when we get that income, whether it's 1099 or whether it's bank statement, there is a factor that Jose mentioned. I don't know if everybody caught that. But 1099s have a simpler factor, I would say. But yes, the CPA is the only way to change the factor, right? There's always a default factor usually that the programs will have. They'll say if you're a contractor, your factor is going to be 50%, right? Because you got to buy materials. If you're an Uber driver, your overhead's only about 10%, right? So they'll give you 90% of that type of business, right? So they'll have a default. But if you say, hey, I'm a contractor, but I don't buy materials, right? I'm labor only, right? I just get paid dollars for labor. So my overhead's more like zero, right? So then you want to get a letter to change that default factor from 50 to 90 or 10% expenses, right? Because you're more of a laborer contractor, even though your business is a contractor, right? You're not actually doing, buying materials and things like that. So there's different reasons to get the CPA letter. Jose, anything else you want to add on that?
No, no, just that keep in mind, like all non-QM programs, they're all going to have variations in their guidelines. So we can't generalize and say across the board it's going to be this. The only way to properly answer that question is to have a specific program, a specific 1099 program in mind. Then we would have to review that program's guidelines to see if they have any, if there's a default uh, factor, and then how they let you adjust it, if they let you adjust it.
And some will have limits, right? If you're a contractor, some won't ever let you get to that 10% because they know you have other expenses, right, that you maybe don't mention, right? So, like Jose said, there's caps on different income or different job types. All right, last question. We're a little over time here, but thanks everybody for staying on. But a great question here from Caroline. When calculating 1 year 1099, do they need to have 5 year history of a business? So I think you're mixing two different guidelines here, Caroline. But the correct answer, I appreciate you bringing this up, is even with 1 year 1099, they need 2 years of self employment history, just like any program. Not 5 years. 5 years is to get 1 year findings, right? So you're mixing conventional, where if a business has existed for 5 years, many times Freddie and Fannie will both give us 1 year findings where we only have to provide 1 year, even though they have to be employed for 2 years. So it's always 2 years. It's a different thing, right? Anything to add on that, Jose?
Nope, that was perfect.
Yep, just always 2 years self-employment for any of our programs. There are some, so we do have some that will do less history, right? And some weird, if you transition from W-2 to 1099, things like that. So don't think you're out of gas if you only have 1 year, not quite 2 years. However, for all of our standard stuff we went over today, just because Jose priced it as 1 year, they still must provide 2 years of self-employment history.
That's a very good point you made there, where there is that exception that may be possible if they were doing the same type of work, the same business previously as a W-2 employee, and now they're in the same exact line of work as 1099. you may be able to get an exception to use the 1 year's employment history, but it has to be complete. By 1 year, it doesn't just mean, okay, 20, I got 2022, but they only had 4 months in 2022. That's not going to work. By 1 year, they're talking about 12 months. And then in that case, we could put it up for an exception, put some good compensating factors, and see if they will grant us the exception because our borrower is so solid.
Yes, sir. So there's always workarounds. That's why we love non-QM guys. Remember, everything you see today, there's always still exceptions to the rule where if we don't quite meet everything, we can always try to get an exception. Or since there's 4,000 programs, that's the beauty of non-QM, we just find a different flavor of that program that allows that one little thing we need, which in this example would be some sort of exception to the employment. So great examples there. Thank you everybody for tuning in. We went a little over time today. We tried to keep it to half an hour, but thanks everybody for staying long. Let's go ahead and sign off here. If you guys need to get a full loan estimate, remember we have over 300 loan officers licensed in 22 different states. Hopefully one of our loan officers sent you this video. If not, you can check out the link right down below, themortgagecalculator.com. Request to get a quote from any of our team members, and they'll be happy to send you one of those beautiful quotes like Jose pulled up with all the details. So thank you all for joining us today, and thank you, Jose, for the deep dive. And we will see you guys tomorrow, 11 a.m., for the final episode for the week. Thanks, everybody.